Hi, this is Shane with the Rational Trader. It is Wednesday the 18th, and we're looking at a daily chart of the NASDAQ, and in particular, the bottom subgraph here, down here. This is the average daily range. I think it's using a 10-period average. And what we can see here very clearly is, there's a big change in the volume here, or I'm sorry, in the range, right there in particular. And then again, you get another big spike here. The market settles down a bit, and then we get a big jump again. And what I've been noticing is that the performance as we've gotten better here has not been as good as I was expecting relative to what I've seen in the past. And I got to thinking about that, and I realized that the data in these areas is a problem. Okay, now if you subscribe to the philosophy that as the volatility goes up, the unpredictability goes up, and which is really another way of saying that the markets are more random. You could look at these periods and say, well, the data that represents the trading for these times is basically random. And so if you then train the machine learning system on that, what you're doing is you're training the system against random data, which makes no sense at all. All right, this is like trying to train a machine learning system to predict the outcome of the roll of the dice. All right, it's not going to be able to do it. And so basically we're polluting the models by using data from these periods, and was the hypothesis that I was pursuing today as I was trying to understand why my performance isn't matching what I was expecting as the markets have settled down here. And so what I did is I went and I took a model and I stopped the data right there. Okay. I only trained the model on data through February 2nd. Okay. So we just take out this actually I took out this entire period right here. Wrong one. This whole period is just not in the model now that I tested. Though in looking at this, it would be reasonable to just take out the pink circles. But anyway, what I did is I only trained the model on data through the 2nd, and then I ran a replay for April. Now it's actually not. It probably would have been better to run the replay on these days where the average range had come down, or where I had. I can, basically what I do every day is look at the overnight range and see how big it is, and use that as a measure for what I expect for volatility for that day. I actually ran the test before I looked at this chart in this level of detail. So I think a test on these days would be very interesting through here, and then really starting just the last few days. What I did though is I ran a replay. I considered February and March too volatile to trade, and just did a replay for April. And what we see is that the performance is quite a bit better actually. So 1850 through the 2.5 weeks of April, and it's very much kind of how you see normal trading. It's you have some good days and then manage risk, and then have a good day and then manage risk. And so the point here is that we need to. There's a part of the approach in mathematics to how you look at data is getting rid of outliers so that they don't skew your analysis. And we have the same issue with machine learning. It's actually more acute, though more difficult to spot sometimes, in that the input data can be biased in one way or another. And so this very much looks to me like a case where the I'm basically have been collecting the data from the previous week, adding it to the big pile of data I have, and retraining every week, which is the philosophy to keep current with with the market behavior. But if these periods of time are essentially random, then they should be removed. All right, so it's another term for it is clipping. You clip the outliers so that you don't screw up your analysis, or in this case, you don't screw up the model. So I did that, and I can see very clearly that the approach looks very sound. Needs a little more testing, and there are ways to very easily determine what to include or not. So there are things like just looking at the standard deviation of the range at that period of time, or in the case of in trading, I know this market so well, I can do things like look at the overnight range for that day and just exclude it if it's higher than a certain number. Very, very similar to what we do when we approach the day, right? If it's more than 60 points, we're a lot more careful. If it's more than 100, we don't trade at all. These kinds of things. And so I'll be doing that here as we approach the weekend. I'll be doing a lot of testing in the next couple of days, actually, aimed at removing, aimed at clipping the data, so that we're not skewing it. And this is the kind of thing that sort of in retrospect seems obvious, but all the data I've been working with hasn't had extended periods of massive volatility like this. This is crazy. And so it's something that didn't come up in my earlier testing. So I'm going to make that adjustment, and then we will see how that plays out. The other thing I need to do here is this test here was run with a limit entry offset of 5, just kind of accidentally. We were talking about this in the room today. What that means is that when you place the order, the order gets placed 5 ticks back from the end of the bar, and so instead of 1 tick back, which is kind of what we normally do. And so as a result, you get a better entry if the market does come to that point. So if I'm shorting on this bar here, I will instead of placing the order there, well, actually 1 tick up, instead of placing the order there, it would get placed up here. And then if the market does come up to fill you get a better entry, and then you end up not getting stopped out like I did here. In this circle up here, I got tagged today. I got nicked there, and then I got nicked somewhere else as well. I got nicked right here. A couple of nice entries. The system very clearly seeing the turn, but then end up not getting in because, or rather, getting nicked on just the markets are more volatile right now, and so your response to that is either increase your stop or get a better entry. So this is the test that I ran here was using getting a better entry approach. I need to run that again with just kind of a normal entry and see how that works out. So I'll present those results to members tomorrow in the room. I'll run that overnight. That is it for today. We'll talk about this in more detail on this Saturday's weekly update, and then in particular the approach to changing the process to just summarily exclude all of the cases where the data is the market's gotten too volatile, so we don't want to include that in our base model like this.